Silver hit $86 an ounce on December 29, 2025. That's an all-time high. Gold crossed $4,400. Best year for both metals since 1979. Markets went absolutely ballistic. Then came the crash. 8 to 11% in a single day. Largest drop in 5 years. RSI indicators screaming overbought. Technical analysts calling it unhinged. Exchange officials whispering about intervention. And if you know anything about silver history, that word should make your blood run cold. Because this is the third time in 45 years that silver has exploded to astronomical levels. And both previous times, the party ended the exact same way. Exchanges changed the rules mid-game, margins got hiked, and the price collapsed like a house of cards. 1980, 2011, 2026. 3 peaks, 3 interventions, 3 brutal crashes. Pattern recognition says run for the exits. But here's what makes your brain hurt. The 3 peaks look identical on a chart, but they're fundamentally different animals. One was a billionaire monopoly scheme. One was a money printing speculation bubble. And one might actually be a structural shortage disguised as a mania. Understanding which is which might be the difference between getting wiped out and positioning yourself for the trade of the decade. My name is Alex, and I've spent the last 6 months going down the rabbit hole of precious metal cycles trying to figure out if 2026 is history repeating or something we've never seen before. If you're trying to understand whether this rally is real or just another speculative blow-off, make sure to hit that subscribe button and give this video a thumbs up if what I'm about to show you changes how you see this market. Because we're going to dissect 3 moments in history when silver went parabolic, examine exactly what drove each surge, and figure out whether the fundamentals underneath 2026 justify what we're seeing, or whether we're watching the greatest fool theory play out in real time with industrial-grade metals. Here's the thing, everyone gets backwards about market manias. They assume price movement equals mania. Big gains mean speculation. Vertical charts mean bubble. That logic sounds reasonable until you realize it's missing the most important question. What's happening to the actual physical metal while the price is going crazy? Because that answer separates a speculative frenzy from a fundamental repricing. In a true mania, warehouses stay full. Inventories don't move. The price is detached from physical reality. It's all paper games and leverage. But in a structural shortage, warehouses empty. Inventories collapse. The price is trying to reach an equilibrium that actually reflects scarcity. Same chart pattern, completely different animal underneath. And 2026 is the first time in silver history where we might be looking at both happening simultaneously. A speculative mania layered on top of an actual supply crisis. Which means the playbook from 1980 and 2011 might not work anymore. Let me show you why that matters by walking through what actually happened in those previous peaks. Because the devil is always in the details. 1980. The Hunt Brothers' Silver Corner. This is the story everyone thinks they know, but most people miss how insane the mechanics actually were. Nelson Bunker Hunt and William Herbert Hunt, Texas oil billionaires, sons of H.L. Hunt, one of the richest men in America. These guys looked at silver in the late 1970s and decided they were going to own all of it. Not some of it, not a large position, all of it. They accumulated somewhere between 100 million and 200 million ounces of physical silver, plus massive futures positions. That's roughly 1/3 of all the silver in the world not held by governments. Think about that scale for a second. 2 individuals controlling 1/3 of global supply. January 1979, silver was trading at $6 an ounce. 12 months later, January 18, 1980, it hit $49.45. That's a 713% gain in 1 year. Tiffany and Company was so furious about the price surge they took out a full-page ad in the New York Times condemning what they called unconscionable hoarding. A jewelry company bought newspaper space to publicly shame the people breaking their business model. That's how extreme this got. But here's what actually made the Hunt strategy work. Leverage. They weren't buying with cash, they were using futures contracts with massive margin, meaning they controlled hundreds of millions of dollars worth of silver while only putting up a fraction of the capital. As long as the price kept rising, the strategy was self-reinforcing. Their buying pushed prices up. Higher prices increased the value of their positions. Increased value meant more collateral for more buying. It was a flywheel, and it worked spectacularly until it didn't. Because while the Hunts were busy cornering the market, regulators and exchange officials were watching this monopoly play out in real time and realizing it threatened the entire system. If two guys could corner silver, what stopped them from doing it to other commodities? So the exchanges did what exchanges always do when someone breaks their game. They changed the rules. January 7th, 1980, COMEX enacted something called Silver Rule 7. Position limits dropped from 5,000 contracts per trader to 2,000 contracts. Margin requirements increased dramatically. But that was just the warning shot. 2 weeks later, January 21st, 1980, the exchange implemented liquidation-only trading. Read that again. Liquidation only. You could sell your silver positions, you could not buy new ones. The market became one-directional by regulatory fiat. Simultaneously, Federal Reserve Chairman Paul Volcker was jacking interest rates into the stratosphere to fight inflation. Rates went from 11.75% to 20%. When you're running a leveraged empire built on borrowed money, 20% interest rates are a death sentence. The cost of maintaining those margin positions became catastrophic. And here's the part that tells you everything about what this really was. 1 week after the Hunts stopped their accumulation activity, Volcker started cutting rates again. The timing wasn't coincidental. The rate hikes weren't about inflation, they were about breaking a monopoly. March 27th, 1980, Silver Thursday, the day it all collapsed. Silver crashed from $21.62 to $10.80 in a single trading session. 50% drawdown in one day. The Hunts couldn't meet a $100 million margin call. Their paper profit of $7 billion turned into $1.7 billion of debt. They were bankrupt. But here's the terrifying part. Their bankruptcy threatened to take down major financial institutions. A consortium of banks had to provide a $1.1 billion bailout to prevent systemic collapse. By 1982, silver was trading at $4.90 an ounce, 90% below the peak, and it didn't revisit $50 for 31 years. That's not a correction, that's an obliteration. The verdict on 1980 is simple: classic mania. Two individuals with infinite leverage cornered a market. No fundamental demand existed. Industrial consumption didn't change. Jewelry demand didn't explode. The price surge was entirely artificial, created by concentrated speculation. When the exchange targeted those specific actors and removed their ability to continue, the entire structure collapsed instantly. The price returned to baseline because baseline was the actual equilibrium. There was no shortage. Warehouses remained fully stocked throughout the entire episode. It was pure speculation from beginning to end. Now let's jump forward 31 years. 2011, the post-financial crisis quantitative easing era. This one looked completely different on the surface, but ended almost identically. Silver went from $8.50 an ounce in 2008 to $49.82 in April 2011. Different drivers this time: zero interest rates. Quantitative easing round 2. The Federal Reserve printing money at unprecedented scale. European debt crisis creating currency instability. Dollar weakness. And critically, the rise of silver ETFs, exchange-traded funds that allowed retail investors to speculate on silver without ever touching physical metal. The SLV ETF became the vehicle for mass speculation. Millions of retail traders piling in, convinced that money printing would cause hyperinflation and precious metals were the only safe haven. The technical indicators were screaming. RSI, Relative Strength Index, hit extreme overbought levels. The kind of readings that historically precede crashes. Silver gained 50% in the first 4 months of 2011 alone. Reddit before Reddit existed. Everyone had a silver story. Everyone knew someone making a fortune. The retail enthusiasm was peak mania behavior. But remember what I said earlier. The question isn't whether people are speculating. The question is, what's happening to physical inventories? In 2011, COMEX warehouse stocks were stable. Industrial demand was steady, but not extraordinary. The price surge was driven by financial speculation, not physical shortage. It was leverage and momentum, not supply and demand. Then came the intervention. Late April, early May 2011. CME, Chicago Mercantile Exchange, raised margin requirements 5 times in 9 days. Let that sink in for a second. 5 margin hikes in 9 days. Margins went from 4% of notional value, which meant you could control $25 of silver for every $1 you put up, to 10%, meaning you could only control $10 for every dollar. The cost of holding a leveraged position more than doubled overnight. If you were running 25 to 1 leverage and suddenly you could only run 10 to 1, you had 2 choices. Add massive amounts of capital immediately or liquidate. Most people liquidated. The timing was surgical. This happened right as Osama bin Laden was eliminated, which triggered a broader risk-off sentiment in markets. And critically, QE2 was ending in June 2011. The money printing that justified the rally was stopping. So you had margin hikes, risk-off sentiment, and the end of the monetary policy that started the party, all happening simultaneously. Silver dropped from $49 to $26 in a matter of weeks, 47% decline. Leveraged funds were forced out of positions at catastrophic losses. By December 2015, silver was trading at $13.82, 72% below the peak. The verdict on 2011 is equally clear. Speculative mania riding monetary policy. Quantitative easing created liquidity. ETFs democratized access. Leverage amplified momentum. But when QE ended and margins increased, the artificial demand evaporated instantly. There was no structural shortage, warehouses weren't emptying, industrial consumers weren't scrambling for supply. The price was detached from physical fundamentals. It was paper speculation, and when the paper game ended, the price collapsed back to reality. So now we arrive at 2026, and this is where everything I just told you might be completely irrelevant. Because the setup looks terrifyingly similar to both previous peaks, but the fundamentals underneath are radically different. Silver gained 148 to 62% in 2025 depending on which analysis you read. Strongest year since 1979. Gold rose 64 to 70% to over $4,400 an ounce. Also the best year since 1979. The gold to silver ratio compressed to 58 to 1, meaning silver was outperforming gold significantly. December 29, 2025, silver hit $86.62, all-time high. Then came the crash. 8 to 11% in one day, largest single-day drop in 5 years. What I'm about to show you next is the thing that took me months to piece together, and it's the key to understanding whether this is a trap or an opportunity. Because on the surface, 2026 has every characteristic of a speculative blow-off top. RSI above 85 on both daily and weekly charts. Those are technical exhaustion signals. Record-breaking weekly gains that looked parabolic. UBS, one of the largest banks in the world, called the December price action unhinged. That's not bullish commentary, that's a warning. The 8 to 11% single-day crash exhibited classic volatility spikes you see at tops. Every technical indicator was flashing red. If you showed me that chart without context, I'd tell you to sell immediately and ask questions later. But then you look at what's happening in the physical market and your brain breaks, because it doesn't match the pattern. 5 consecutive years of supply deficit, not 1 year, not 2, 5. The cumulative deficit according to the Silver Institute World Silver Survey is 678 million ounces. That's not a rounding error. That's a structural imbalance. Industrial demand is now consuming 60% of total silver production. And this isn't discretionary industrial demand. This is solar panels, electric vehicles, and AI infrastructure. Non-discretionary applications. In 2025, the U.S. Geological Survey designated silver as a critical mineral. That's a formal government classification recognizing that silver is essential to national security and economic stability. That designation doesn't happen for metals with abundant supply. Here's why the supply side is the critical piece. Silver supply can't respond to price signals the way normal commodities do. When oil prices spike, producers drill more wells. When copper prices surge, miners expand operations. It takes time, but supply responds. Silver is different. 75% of silver production is a byproduct of copper, lead, and zinc mining. It's not the primary target. It's what you get while digging for something else. Which means even if silver hits $200 an ounce, you can't just open new silver mines quickly. According to S&P Global, the average timeline to bring a new mine from discovery to production is 6.5 years. You can't fix a supply deficit in 6 months when the solution takes 6.5 years. The supply is structurally inelastic, and demand is equally inelastic on the industrial side. If you're building a solar panel, you need silver paste for conductivity. There's no substitute that works as well. You can't delay the project because silver is expensive. You can't redesign the panel in 3 months. You have to buy the silver regardless of price. If you're manufacturing EVs with advanced electronics, you need silver for contacts and conductivity. The car doesn't work without it. You're not price sensitive, you're supply sensitive. If you're building AI data centers with high-performance computing, you need silver for thermal management and connectivity. These are non-negotiable applications. Industrial buyers aren't speculating, they're not checking RSI indicators. They're trying to secure physical supply for production schedules. And when there isn't enough physical silver to meet production needs, the price has to rise until it reaches a level where either new supply appears or demand gets rationed. That's not a mania. That's a market trying to find equilibrium. Now here's where your head should be spinning, because both things can be true simultaneously. You can have a structural shortage and a speculative mania at the same time. They're not mutually exclusive. In fact, structural shortages often attract speculation. When fundamentals are strong, momentum traders pile in. When momentum traders pile in, you get parabolic moves. Parabolic moves attract more speculation. The speculation pushes prices beyond what fundamentals alone would justify. Then you get the technical exhaustion signals. RSI goes crazy, volatility spikes, and suddenly it looks exactly like a mania even though the underlying shortage is real. This is the trap of pattern recognition. Your brain sees the chart from 1980 and 2011. The pattern looks identical, so your instinct says this ends the same way. Exchanges will intervene, margins will spike, leveraged speculators will get flushed, price will collapse back to baseline. That's what happened twice before, so that's what happens now. Except baseline might not be where you think it is anymore. In 1980, baseline was around $6 because that's where supply and demand actually balanced when you removed the Hunt brothers' artificial demand. In 2011, baseline was around $15 to $20 because that's where the market cleared when you removed QE-driven speculation. But in 2026, what's baseline? If you have 5 consecutive years of supply deficits and industrial demand that can't be delayed or substituted, baseline might be $40 or $50 or $60. Nobody actually knows because we've never had a structural shortage of this magnitude coincide with a speculative surge. The historical playbook assumes the shortage is fake. It assumes warehouses are full and the price spike is purely speculation. But what if warehouses are actually emptying? What if COMEX stockpiles are drawing down despite rising prices? That's never happened in previous silver peaks. In 1980, inventories were stable throughout. In 2011, same thing. But multiple analyses of COMEX data show inventory draws in 2025 even as prices surged. That's the signature of real demand overwhelming supply. That's not speculation, that's scarcity. We're halfway through, and if you've made it this far, you're already ahead of 90% of people trying to understand this market. But don't stop now, because what comes next is where we figure out the actual difference between a mania and a repricing, and why getting this wrong could cost you a fortune either way. Because here's the brutal truth. If this is a mania like 1980 and 2011, and you stay long, you're going to watch 80% of your capital evaporate in 6 months. But if this is a structural repricing and you sell at the first sign of volatility, you're exiting right before the real move happens. Both mistakes are catastrophic, so we need a framework to tell them apart. Let's build that framework by defining exactly what a mania looks like versus what structural repricing looks like. A mania has specific characteristics. First, speculation is completely detached from fundamentals. The price movement has no relationship to actual supply and demand. The Hunts weren't buying silver because industrial demand was surging. They were buying because they wanted to corner the market. Retail traders in 2011 weren't buying because solar panel production was exploding. They were buying because they thought QE meant hyperinflation. The speculation creates its own reality. Second characteristic of a mania, leverage amplifies price beyond intrinsic value. The moves are too big, too fast, too vertical to be justified by fundamentals. Third, removal of leverage returns price to baseline almost immediately. The second you take away the margin, the structure collapses. And fourth, warehouses remain stocked throughout the entire episode. Physical inventories don't move. The metal sits there while the paper price goes insane. Those four characteristics together define a mania. Structural repricing looks totally different. First, supply-demand imbalance exists independent of speculation. Even if every speculator left the market tomorrow, you'd still have more buyers than sellers at current prices. The imbalance is real. Second, price must rise to equilibrium regardless of leverage. You're not amplifying a fake move. You're discovering the actual clearing price. Third, removal of leverage creates a buying opportunity for fundamental buyers. When speculators get flushed, industrial buyers step in because they need the physical metal. The price doesn't collapse to zero because real demand catches it. And fourth, warehouses draw down despite rising prices. This is the critical tell. If inventories are falling while prices are surging, you have real scarcity. The price isn't too high. It's trying to reach the level where supply and demand actually balance. So let's score 1980 and 2011 against that framework. 1980. Speculation detached from fundamentals? Absolutely. Two billionaires cornering the market has nothing to do with industrial demand. Leverage amplified price? Completely. The Hunts were running borrowed money. Removal of leverage collapsed the price? Instantly. Warehouses stocked throughout? Yes. Physical inventories were fine. Verdict, pure mania. All four characteristics present. 2011. Speculation detached from fundamentals? Yes. QE created liquidity, but industrial demand didn't justify $50 silver. Leverage amplified price? Absolutely. ETFs and margin trading drove the surge. Removal of leverage collapsed the price? Immediately. Warehouses stocked? Yes. No inventory crisis existed. Verdict, pure mania. All four characteristics present. Now let's score 2026. Speculation detached from fundamentals? Here's where it gets complicated. Yes, there's speculation. The parabolic move in December was momentum driven, but is it detached? Industrial demand is consuming 60% of production. 5-year supply deficit. That's not detached, that's fundamental. So this gets a partial score. Speculation exists, but it's riding on top of real fundamentals. Leverage amplified price? Probably. We're definitely seeing momentum and technical buying, but we're also seeing industrial buyers scrambling for supply. Mixed score again. Removal of leverage returns price to baseline? We don't know yet. The crash happened, but the price is still significantly elevated from 2 years ago. It didn't return to $20. It's holding in a higher range. That suggests there's a floor. And here's the big one. Warehouses stocked throughout? No. This is the critical difference. COMEX inventories have been drawing down. Registered silver available for delivery has been declining even as prices surged. That's the opposite of a mania. That's scarcity. So when you score 2026 against the framework, it doesn't fit cleanly into either category. It has mania characteristics, specifically the technical exhaustion and parabolic price action. But it also has structural shortage characteristics, specifically the inventory drawdowns and inelastic industrial demand. This is the first time in silver history we've seen this combination, which means the historical playbook might be completely wrong. Pattern recognition fails when the pattern doesn't actually match. Now let me tie all of this together because when you see how these pieces connect, the picture becomes crystal clear. The reason 1980 collapsed 90% wasn't just because exchanges intervened. It collapsed 90% because there was no fundamental support. Once the hunts were out, there was no reason for silver to trade above $10. The market had no shortage, no surge in industrial demand, no supply crisis. The entire move was artificial. Same with 2011. Once QE ended and margin costs increased, there was no fundamental reason to own silver at $50. Industrial demand was steady, supply was adequate. The move was purely financial speculation. When that speculation reversed, the price had nowhere to go but down. But 2026 is different because even if you remove every speculator tomorrow, you still have a problem. You still have industrial buyers who need 60% of annual production for non-negotiable applications. You still have a 5-year cumulative deficit. You still have a supply base that can't respond for 6.5 years even if prices double again. That's a floor. Maybe not at $86. Maybe the speculative premium was $20 or $30. But the floor isn't $15 anymore. It's not even $30. The structural shortage puts a floor under this market that didn't exist in previous peaks. Here's the question that matters. If exchanges intervene and hike margins like they did in 1980 and 2011, what happens this time? In a pure mania, leveraged speculators get wiped out and the price collapses because nobody actually needs the metal. But in a structural shortage, leveraged speculators get wiped out and industrial buyers step in to secure supply at lower prices. The price falls, but it doesn't collapse to baseline because baseline has moved. You get a violent flush of weak hands followed by stabilization at a higher equilibrium. That's a repricing, not a mania pop. And that's the scenario that makes your brain hurt. Because it means the crash you're watching might not be the end of the move. It might be the shakeout before the real move. Or it might be the beginning of a total collapse. Both are possible. And the only way to know which is to watch what happens to physical inventories over the next 6 months. If COMEX stockpiles stabilize or start rebuilding as prices fall, that tells you the shortage was exaggerated and this was primarily speculative. Supply is catching up. Demand is being rationed. The market is returning to balance at lower prices. That's the 1980 and 2011 playbook. Sell everything and don't look back. But if inventories continue drawing down even as prices fall, that tells you the shortage is real and the market is trying to ration demand through price. In that scenario, every flush is a buying opportunity because the structural imbalance hasn't been resolved. The market is just cycling through waves of speculation and liquidation while the underlying shortage gets worse. That's the scenario that's never happened before. And it's the scenario that could turn silver into the trade of the decade if you have the stomach to ride through the volatility. Or it could be the trap that wipes out everyone who thinks this time is different, because this time is different is the four most expensive words in investing. Almost there. But before I wrap up, I need to show you how all of this works together and why the honest answer is more valuable than a prediction. Because every financial guru on the internet is going to tell you they know what happens next. They'll say with total confidence that silver is going to $150, or they'll say it's going to 15. They're selling certainty. I'm giving you framework. Because the truth is, we don't have enough historical data to know how this resolves. We have two previous silver peaks, and both were pure manias with no structural shortage. We have one current silver peak with mania characteristics layered on top of potential structural shortage. Sample size of 1. That's not enough to make predictions. That's barely enough to ask intelligent questions. But here's what we do know. History doesn't provide a template because previous peaks didn't have structural deficits. 2026 is the first silver peak where warehouses are emptying while prices rise. That's never happened before. The Hunt Brothers Corner didn't draw down inventories. The QE speculation in 2011 didn't create supply shortages. But 2026 might have both speculation and shortage happening simultaneously. If that's true, the playbook from previous peaks is wrong. If that's false, and the shortage is exaggerated or temporary, then the playbook from previous peaks is exactly right, and everyone long silver is about to learn an expensive lesson. The framework I just gave you is how you navigate that uncertainty. Watch the inventories. Watch industrial demand. Watch whether supply can actually respond at these price levels. If new mines start coming online in 12 to 18 months, that tells you supply elasticity exists and the shortage was temporary. Price comes down. If new supply doesn't materialize because 75% of silver is byproduct and primary miners can't justify projects, that tells you supply is structurally constrained and the shortage persists. Price stays elevated or goes higher. If industrial buyers start substituting away from silver or delaying projects, that tells you demand is more elastic than expected. Price pressure eases. If industrial buyers keep consuming regardless of price because they can't substitute, that tells you demand is truly inelastic and the shortage is real. The framework gives you a decision tree. You don't need to predict. You need to observe and react. And here's the part that brings us full circle. Remember how we started? Silver hit an all-time high and crashed in a single week. Looked exactly like 1980 and 2011. Everyone's screaming about exchange intervention and margin hikes and the end of the rally. But you're not everyone anymore. You understand that pattern recognition fails when patterns don't actually exist. You understand that mania and structural shortage can coexist. You understand that the question isn't whether this is speculation. The question is whether there's a fundamental floor underneath the speculation. And you understand that the answer reveals itself through inventory data, not price charts. You're not gambling on predictions. You're watching the physical market and letting reality tell you what's real. 3 peaks, 3 interventions. 2 were pure speculation. 1 might be different. The mistake is assuming you know which category this falls into before the evidence is clear. Stay humble. Watch the data. And remember that the most expensive position in markets isn't being wrong. It's being certain when you should be curious. The silver story isn't over. It's just getting started. And whether you make a fortune or lose one depends entirely on whether you're watching the right indicators. Don't watch the price. Watch the metal.